What if 2026 becomes the year where disciplined investors outperform hype traders? What if instead of chasing random momentum stocks, you focus on companies that are already growing revenue, expanding their customer base, and building long-term competitive advantages? Before we go deeper, if you appreciate real stock analysis without fake hype, make sure you like this video, comment your favorite stock for 2026, and share it with someone serious about investing. And if you're new here, subscribe to Investor Codes, where we break down growth stocks, market trends, and smart investing strategies in a practical and realistic way. Now, let's talk about 5 incredible growth companies that could remain strong into 2026, not because of hype, but because of fundamentals. First, SoFi Technologies. SoFi has evolved far beyond its early days as a student loan refinancing platform. Today, it operates as a digital financial ecosystem. It offers checking and savings accounts, personal loans, home loans, investing services, credit cards, and financial tools, all inside one app. That ecosystem approach is powerful. When customers use multiple products within one platform, customer lifetime value increases and marketing costs per product decrease. Over the past few years, SoFi has focused heavily on growing its member base and then cross-selling additional services to those same members. That strategy can improve margins over time. Another important factor is SoFi's banking charter, which allows it to hold deposits and fund loans at potentially lower cost compared to non-bank fintech competitors. If interest rates stabilize in 2026 and credit conditions remain manageable, SoFi could continue expanding revenue while improving profitability. However, this is still a lending-driven business. If the economy slows sharply or defaults increase, growth could be pressured. SoFi is a growth stock with upside potential, but it is also sensitive to macroeconomic conditions. Next is Mercado Libre. Many investors compare it to Amazon, but Mercado Libre is actually more than that. It operates a powerful e-commerce platform across Latin America while also running Mercado Pago, its digital payments and fintech arm. In many Latin American countries, traditional banking access is still developing, and digital payments adoption is rising quickly. That gives Mercado Libre exposure to both commerce growth and financial inclusion trends. The company continues investing heavily in logistics infrastructure to improve delivery speed and customer satisfaction. That investment reduces friction for buyers and sellers, strengthening its network effect. As more users join the platform, more sellers are attracted, and as more sellers join, buyers benefit from broader selection. The fintech side adds another layer of growth because payment processing, credit services, and digital wallets create recurring transaction revenue. Risks include currency volatility and regional economic instability, but long-term digital adoption in emerging markets remains a strong secular trend. Then we have On Holding, a premium athletic footwear and apparel brand. Unlike traditional brands that compete on price, On has positioned itself in the premium performance category. That brand positioning allows it to command higher margins and attract loyal customers. The company has been expanding internationally, particularly in North America and Asia. It is also focused on direct-to-consumer sales through its own channels. Direct-to-consumer typically offers higher profitability than wholesale partnerships. Brand-driven companies can scale significantly if they maintain product quality and customer loyalty. The risk, however, is that consumer discretionary spending can fluctuate. During economic slowdowns, consumers may delay premium purchases. For On to maintain growth into 2026, it will need to continue product innovation, marketing effectiveness, and geographic expansion. If it executes well, it could remain a strong growth story in the athletic wear space. Lemonade is a different kind of growth opportunity. It is attempting to disrupt the traditional insurance industry using artificial intelligence and automation. The company's platform handles underwriting and claims digitally, aiming to reduce operating costs and speed up processing times. Lemonade has expanded from renter's insurance into homeowners, pet insurance, auto insurance, and life insurance. The long-term thesis is that AI-driven underwriting can create a more efficient insurance model. However, insurance is a complex business. Growth alone is not enough. Profitability depends heavily on loss ratios, pricing accuracy, and risk management. If Lemonade can improve its underwriting performance while continuing to scale customers, investor sentiment could improve significantly by 2026. But this is one of the higher risk names on the list. It requires strong execution and disciplined risk control. Finally, Taiwan Semiconductor Manufacturing Company plays a foundational role in global technology. TSMC manufactures advanced semiconductors used in AI systems, data centers, smartphones, and high-performance computing. Many of the world's leading chip designers rely on TSMC for fabrication. As artificial intelligence demand continues and cloud infrastructure spending grows, advanced chip manufacturing remains critical. One of the key strengths of TSMC is its technological leadership in advanced node manufacturing. That expertise creates a high barrier to entry. Even if different tech companies compete with each other, many of them still rely on TSMC's manufacturing capabilities. The major risk here is geopolitical tensions surrounding Taiwan, which can create market volatility. But from a business standpoint, semiconductor demand tied to AI and computing remains structurally strong. When you look at these 5 companies together, you're not looking at hype plays. You're looking at businesses operating in fintech, emerging market commerce, premium consumer brands, digital insurance innovation, and semiconductor infrastructure. Each one has a clear growth driver. Each one also has risks. Growth investing in 2026 will likely reward companies that can increase revenue consistently while moving towards stronger margins. It's not about short-term spikes. It's about sustainable expansion. That means paying attention to earnings reports, balance sheets, cash flow trends, and management execution. Remember, this is not financial advice. I'm not a financial advisor. Always do your own research before investing. Markets can correct unexpectedly, and even strong growth stocks can experience significant volatility. If you found this breakdown helpful, again, like the video, comment which stock you believe has the strongest potential for 2026. Share this with someone serious about building wealth and subscribe to Investor Codes for more real practical stock analysis. Smart investing isn't about hype. It's about discipline, patience, and understanding the businesses you own.